Just went on Thursday, May 22nd, 2014. We had a grinding, drifting kind of day in the market overall. However, individually, especially in these beaten down growth names, we saw some reasonably constructive action, at least for the short term. Now, it is so important to understand the forest for the trees perspective, and that's why we try to go through that in these videos on a nightly basis and over the weekend, and constantly focusing on competing time frames, because it's very important to understand that I am still of the view, for example, growth stocks have actually peaked for this particular bull market. And yet they became so beaten down, so hated, so punishing to dip buyers and bulls who were holding the whole way down, some of them down 50, 60% in just a couple weeks' time, that they became so bad they almost became short-term good, if not just for a quick bounce. So again, you can play those on the long side. I've been playing them a little bit. I was long FireEye earlier in the week, looking at some of them now, but again, know your time frames. I'm inclined to be a seller into these pops than I am, let's say, to get the ball rolling and snowball and build a position kind of into strength at this point, because of my longer term view that growth stocks have peaked. And I've not seen nearly enough price action yet to push me anywhere close to getting pushed off of that thesis. Still think the small caps, the biotechs, and many of those high growth stocks in the NASDAQ, they've had terrific multi-year runs, and I think they are starting to show their age. And yet we do have resilient parts of the market. The S&P 500 index, again, daily time frame, still no clear resolution out of this basically sideways range since early March. Obviously, we're near the top of the range, near recent 1902 all-time highs. Above all these moving averages, still a very resilient chart. Still no 10% correction, though, and still no 200-day moving average S, both since the year 2012. So I'm still not seeing along with this chart, along with what I just stated, the no 10% correction, no 200-day moving average test on the S&P, as resilient as it's been, I'm still not seeing, let's say, a proliferation of the kind of high-quality individual setups that you want to see to get that kind of fall 2010 healthy market. First quarter 2012, first quarter 2013 kind of real healthy, broad-based market. That's what I tend to look for to get real aggressive on the long side and kind of swing things for months on end. In this particular market, again, I'm still inclined to be more the sniper variety, in, out, nimble, both sides of the trade. Having said that, and this is something you heard me say yesterday and even before, again, once Tuesday's sell-off pretty much got negated, the thesis walking into this week held true, that we're in a holiday-esque week. Memorial Day on Monday, long holiday weekend. You can be sure plenty of traders, especially traders of size, today and definitely tomorrow will be away from their desk, going to the beach, doing whatever. Volumes are likely to shrink. It is likely, again, if everyone is thinking the same way, what I'm articulating here, then maybe it's not going to work out. But typically, the way it works is you don't want to be a gunslinger, a hero, macho man on the short side, especially with these beaten down growth names, because they've already taken a shellacking and they're already beaten down, and now they're starting to show signs of being in temporary bounce back mode. It's typically not very fruitful, again, to play macho man on the short side in front of a holiday, a major flag waving holiday like Memorial Day. I think in June, maybe next week, we can take a look at the short side again if we see signs of resistance and overhead supply starting to kick in and some rollovers. Volatility is very cheap. I'll get to that in a moment. But again, S&P, no real range breakout yet, but very resilient index. Dow Jones Industrial Average, no real resolution yet, but resilient index, and it's too early to call this a bona fide bull trap. So we're just still, what we do know is the S&P and Dow remain resilient on a relative basis, but even they have been essentially range bound the past couple of months. Now, the leaders, the NASDAQ, again, they kind of led down, but now showing signs, again, of being in snapback rally mode. We've talked about this ad nauseum, really, but it still has a declining 50-day moving average. It even now has, the NASDAQ actually has a slightly declining 100-day moving average, the whitish-grayish line on my chart. So, yes, we can overshoot it tomorrow up to 4,200 if we get a real big rally into the weekend, or higher next week. But I'm still a little skeptical at this point of declaring that a healthy uptrend is imminent per se. I do think we can kind of grind up here, and then maybe up at these levels, let's say 4250, that area, that might be more the spot where you see patient bears kind of hop in and press. I'm very reticent of this idea that the worst is over and we're off to the races. I know there's this idea that we could be on the cusp of a blow off top. I think that is always the possibility at the end of a bull market. But again, it's typically not something you always want to bet on. Remember, 2007 kind of ended with a whimper, so to speak, rather than a bang. Bear markets tend to end with the bang, with the big crash. And then you get a couple months of basing out, like October 2008 through March 2009, and you make a series of lows. Bull markets are not quite as pronounced as that. Usually it's a big topping process, and this could be it, and I want to respect that, but even if it's not it, okay, and again, I don't do these videos to make the big top call all the time. I think we saw enough damage in the growth stocks for me to look for that to be kind of their peak, and we could still get what's known as a right shoulder rally into the summer where they just kind of grind higher. But still, what I do know, and again, you want to talk in terms of things which are much more tangible in technical analysis, we have a very steep trend in the NASDAQ since November 2012, which has been broken. We have a declining 50-day moving average, and that, again, even if price overshoots, a good reason not to get squeezed here. You can see we're in snapback rally mode. These are still issues headed into June that I'm looking at. The same thing with the small caps and the Russell. Finally, it's interesting. The IWM, the ETF, excuse me here, the IWM ETF for the Russell actually did not close. I thought it did close late in the day, and then it got faded again. So even with all of this, bounce back mode, bulls are looking for the big uptrend again. Very interesting that the Russell still is below its 200-day moving average. Really incredible. I don't think you're going to see this too many times over the course of your careers where you see, again, like the VIX getting slaughtered, you see the Dow and the S&P basically hitting all-time highs within the past week or two, and the Russell remains pinned below the 200. Yes, we had a hammer a week or two ago, but there's still issues lurking above the declining 50 and 100-day moving averages. And again, these longer-term moving averages, if you are looking for a bear market, let's say you're 100% convinced this is the top, what you're probably going to want to see is price either basically stay around these levels or swoon lower into June. And if that happens, then here's what you need. The 150-day, the red line, and the yellow line, the 200-day, you need to see them smooth out and then torque down. That's your cue, in my view. That's typically a much better view that we're in a bear market than the old rule of 10% is a correction, 20% is a bear market. That is usually kind of rear view mirror kind of stuff. If you are looking for a bear market, that is pretty much your template, in my opinion. Obviously, it hasn't happened yet. So patience. What we do know is, for now, bull market, rising 200-day moving average, and bull market correction still in effect for the Russell, but the Russell became quite beaten down, so you don't want to get greedy on the short side. I hope that makes sense, walking you through that analysis. That, therefore, has given me this posture of being more kind of long bias, especially early in the week with FireEye, and then once we saw Tuesday's sell-off did not amount to anything. With Wednesday's snapback rally, I think, again, the long side becomes viable for a short-term trader. Again, FireEye, here was the hourly chart from earlier in the week. The idea was to look to see if bulls could get above here, this area, and now that they have, we built out, really since we sold it back on Tuesday, FireEye built out a nice consolidation, and now it's threatening a secondary move higher. Again, I think it's good to trade off these hourly 30-minute charts for this kind of holiday week stuff. Workday, similar comments apply. If it gets back above 77 tomorrow, you can see it working through its consolidation, have something to work with there. Splunk, 4650 is probably the level that you want to see it clear once again tomorrow. Yelp, I think, got a pretty good day today. See if you can hold kind of the 60 area into tomorrow. Again, let's take a look at these daily charts. So beaten down, again, that you could easily see Yelp tagging its either upper Bollinger Band or even beyond that, the declining 50-day moving average, which it hasn't done since March. FireEye, again, so bad, maybe it's kind of good, if not just for a short term. Make no mistake, they're not healed, but the 20-day moving average, the upper Bollinger Band, or the 50-day moving average, they're all within shot. Splunk, 20-day moving average, upper Bollinger Band, they all seem to be within shot. Again, if we do get this kind of holiday action Friday, tomorrow, and that kind of thing. Yelp, again, mentioned that. Pandora, even so beaten down, it's tough to be pressing shorts in these guys into the holiday weekend. So I think you're either flat or you're being quick and nimble on the short side. LinkedIn, again, another name I think can run up to. You can see the Bollinger Band's pinched here. Just such a beaten down name since last September. Lower highs and lower lows the whole way down. And now I think it's showing signs. Understand what happened here. We finally got a slight change in character in the sense that we got a nice close over this 20-day moving average, which hadn't happened really since March, I believe. A real bona fide close over. You see the candle completely above 28 moving average. So again, it's still a damage chart. Look at all these declining moving averages above. That's going to be a big issue. But in the short term, if you play it for a pop, I think into the 160s could easily materialize. Triple D, another name we mentioned earlier in the week, again, finally cleared some well-defined resistance today. So it's just that kind of week. That's holiday trading, and I think you can take a look. These are still damaged. I mean, look at Triple D. This is, very bearish typically, and it's played out bearish. We talked about this in real time, just like with Cree. We talked about Cree in real time. These are damaged charts, but again, that will come to fruition most likely up here if it gets there. But in the meantime, I think, well, it's tough to chase Triple D now, but in the meantime, if you're playing it, I think, again, that's a good little play to have in mind. We'll talk about some other holiday ideas. Diamond Foods, if it can get above the 58 moving average again tomorrow, the 32 area, could probably squeeze heavily shorted stock there. Even Mercado Libre, some of these real clobbered. I mean, Mercado Libre has just gotten decimated since really all of 2014, especially since last fall. It's so bad in the short term. If you're looking to play these kinds of names, maybe it's a little bit good just for a quick pop. Again, don't get married to these guys. These are just quick little flips. You get in, get out, get over. Nordstrom, one of the better charts in the tape here, high, tight, bull flag. So that's probably one of your better charts in terms of retail. And again, there are definitely some names I want to look at on the short side. But first, alongside GDP, good rich here. Energy name heavily shorted. Watch it above 26 on the long side. Soon, SUNE, the weekly chart, still pretty impressive here, I believe, with solar exposure. Again, still plenty of weak charts out there. General Motors still a mess. Red today. State Street, even though it bounced back today, I still think this has got a lot of issues, as do most financials here, in my view. Most financials, you can see the XLF wedging back to the 50-day. Most of these banks, they can bounce here. They probably should bounce. Something is very wrong if they can't bounce. But overall, Goldman, the whole I don't think that they're nearly out of the woods. I think there's a lot. I mean, you got JP Morgan here, Jamie Dimon, right? Big hotshot executive, declining 200-day moving average, declining 50-day moving average. That's not a good sign typically at all. Again, a lot of these retail stocks, XRT, they've already gotten clobbered. Ralph Lauren, Coach, consumer names like Panera just decimated, and they've stayed weak. And then we have names like PetSmart, which have triggered major long-term topping patterns. I mean, again, and then you talk about the damage in Lulu and Whole Foods and everything like that. So again, there is this idea that bears have gotten everything wrong is absurd. There's damage underneath the surface. It just takes time to play out, and you have to be nimble and you have to make adjustments. Monsanto, late-stage bull market mover. Again, don't look at these things in a vacuum. Monsanto rallied into June 2008, I believe, and guess when the S&P 500 index topped out? October 2007, several quarters before. So again, understand where we are in the grand scheme of things. Nice breakout in Monsanto. We'll see if Mosaic and Potash follow. They did not today, so I guess Monsanto's kind of trading in its own little world here as far as the ag is concerned. Either way, beautiful move in Monsanto. I would stock it on the long side on any further subsequent consolidations. Treasuries, TLT, look like finally the short should start to work into the summer. We'll see. Again, the VIX just obliterated. We've actually had some very nice winning trades in UVXY on the long side, but you're in, you're out, and then you get out of there. This is not, you do not want to overstay your welcome in these things. You're in, you're out. If it goes against you, you're out even quicker. Again, VXX, in my view, should be setting up for some kind of a summer pop. Typically, even in a raging bull market, you do get a volatility pop into the summer, and this is almost a good setup into the summer in my view. You can see the divergence. VIX actually closed marginally green, and then these things, again, the volatility instruments did not, pretty much got smoked, UVXY and what have you. So I do think that this kind of washout in volatility could easily be setting up a nice snapback trade into the summer. I am into June. I can tell you I am looking to finally do something more than just a quick flip with these guys. I might be trying to build maybe a multi-day or even multi-week position, I should say, in volatility. We'll see. It's something I'm entertaining right now. Natty Gas, if it loses 24, you might get a short there. You can see all the support built up here. It's a big level. DGAZ would be the triple levered bearish ETF if you're looking for action there. So hope you find these ideas useful. That's pretty much the only thing I'm seeing actionable in the commodity space. Metals are a mess. Softs are consolidating. Hope you enjoyed the video. If you're taking off, enjoy the long holiday weekend. Otherwise, have a great night. And again, we'll see you tomorrow.